Welcome back to another episode of Investing Explained. Here's today's question. Ray Dalio has famously said that having 15 uncorrelated assets is the holy grail of investing. So really what you said about an idea of the risk and reward of various sectors and asset classes, I think that is important to have, but I also have the guiding principle that I don't know, which is also why I would like to be diversified. So one thing is that we can talk about position size in the stock market, and I think that's very important. And I would say that I have a relatively concentrated portfolio, but the only reason why I have a concentrated portfolio is also because I have other assets that are not stocks, and they're uncorrelated with the stock market. So I also have a private business, I own some real estate, and a few other assets. That really also influences on how diversified you need to be in the stock market. Another thing that you bring up is the expected return. And yes, I do look at what the risk is of losing my invested amount when I make my position size. I can handle a lot of volatility, but if I do think there's a risk of losing my principal, but have a high upside that justifies it, I would definitely ensure to make many small bets and mitigate the downside risk in aggregate, and then combine it with the upside. But really, there are as many ways to construct a portfolio as there are investors. If we look away from ETF investing, which is different, and you only focus on individual picks, I would suggest that you have between 10 and 20 stocks. With more than 20 stocks, the gain of extra diversification from owning another, say, 100 stocks is almost non-existing, as long as the 20 stocks that you have are already diversified. And you will likely be stressed out more about having 20 stocks in your portfolio and even more on the watch list. And it's probably not worth your time. You can, of course, also choose to buy an ETF. And the ETF that investors typically buy is a market-weighted ETF, meaning that the bigger companies are overrepresented. So, for instance, in the S&P 500, Apple might be 4%. So, if you buy the biggest and most diversified ETFs, it might even be an equal-weighted ETF, and you buy the stock market, you would typically not need more than 2 to 3 ETFs. And depending on your strategy, you might argue that you can just buy one ETF. You have ETFs out there that covers all asset classes and has very, very little volatility. I recommend that you do not have more than 10% of your portfolio in one security. And this is only in securities where you think that the long-term risk of a permanent loss is close to zero. As certain as you might be that the investment thesis is correct, you could be wrong. Like Ken Fisher said here on a recent episode, even the best investors in the world are only right 70% of the time. So definitely always think about what Ray Dalio said about having 15 uncorrelated assets and why that is so important in investing.
So this is such a very, very important question, because if you talk to anybody that's managed money, that's been in the game for multiple decades, they'll be sure to tell you that it's all about position size. So what's incredible is you not only have to find winners, but you have to find winners that aren't correlated, according to Ray Dalio, who is one of the best investors ever. And so I would like to share a tool with you that I found online that has helped me, and it helps you compare and contrast and understand the correlations between various stock picks and also various ETFs. And the tool is called AIstockcharts.com. We'll have a link to that in the show notes if you want to check it out, but it's great because you can put in whatever picks you have, whatever the tickers are, and it'll show you how correlated the picks are. So if you have a portfolio of 10 or 15 stocks and you want to see how correlated they are, you can use this tool to figure that out. It's very useful, and I think you'll get a lot of value out of it. Of all the stock conversations I've had with people through the years, it's very, very rare that you talk to somebody and they talk about how they aren't investing in something, or that they are investing in something because of the correlation between the picks. But I think that if you talk to somebody who's managing an enormous amount of money, this is where they really focus their efforts. They try to find those winners, and they try to understand the correlation between them, because that helps them mitigate their risk.
That's it. Preston and I will continue explaining investing, so go ahead and hit that subscribe button.